During this conference, the topics of the future and past bailouts will be discussed, but also the principle of bailing out in a broader perspective. From the liberal point of view, it illustrates that the government more and more wants to intervene in the free market, and that the government will play a bigger role for the supervisors with all the respective consequences for our prosperity. Hence, there will be made a comparison between the free market economies and extensive market regulation. The pros and cons of regulation will be discussed, and examples of regulations that can be touched upon are the American Dodd-Frank Act and the BIS regulations for banks. In his speech, Bernstein wants to investigate whether lack of financial regulation either in the US or Europe was a principal cause of the last financial crisis, and that massive regulation introduced since then will reduce the chance of future crises in a significant way. Having journeyed, however, so long down the route of regulation, what could force a reversal? What are the political forces which could lead to way back? And what is the image of a better financial system with less regulation which they could market successfully to their electorate? Rate manipulation and inflation targeting and deflation phobia created a powerful virus of asset price inflation. Mr. Brown also indicated that for monetary stability, the institution of too big to fail institutions should be broken up. I agree with that. And greater competition should be aimed at. Additionally, the incentives for banks to invest in government bonds should be discouraged. There's also a comparison with the situation in the USA. I didn't have your paper, otherwise I would have added you in my welcoming speech. So I have to introduce, because the moderator is on her way. She just arrived at 5 minutes past 6 because of difficulties with the Eurostar, so she will come, and I try to introduce Mr. Bernstein Brown, and he starts his speech, and when she comes in I just give her the floor. So Bernstein Brown is the head of economic research at Mitsubishi UFJ Securities International. He advises institutional investment clients in Japan and Europe. Areas of special expertise include the study of global capital flows, European Monetary Union, Japanese monetary situation, international financial stability issues, and capital market pricing. He has an MBA from Chicago and a PhD from the London School of Economics. He is a regular contributor to Financial TV, including Bloomberg and CNBC. Mr. Brown was voted best forecasting economist for Japan in 2011 by Bloomberg magazine. Mr. Brown, I give you the floor.
Thank you very much for your kind introduction, and in fact you've given a very good summary of what I'm going to speak about. And I would, and I know we have question and answers after the talk, but if any of you really want to ask me something as you go along, please feel free to do so. So the title of my talk is What Could Turn the Tide of Financial Sector Regulation? We can identify a number of factors which lie behind the growing regulation of the financial sector in recent years, culminating most recently in Dodd-Frank, the various Basel standards, and a host of EU directives. These factors include the response to terrorism, the 2001 attack in New York, a new hunger for tax revenues by the US and EU governments, and a flawed doctrine of what caused the bubble and bust and what's needed to prevent future bubbles and busts. And finally, I would mention a popular revulsion of paying taxes to bail out the bankers. What I want to look at in particular today is the thousands of pages of detailed regulations on financial intermediation, how these have grown up, and my concern that these are misdirected and misconceived, in the sense that it was not a lack of financial regulation in the US or Europe that was a principal cause of the last financial crisis. And the mass of regulation introduced since then is most unlikely to significantly reduce the chance of a future crisis. Finally, and perhaps controversially, I want to suggest that the continued existence of European monetary union in its present form is an obstacle to Europe finding its way to a stable monetary order in which regulations would be repealed and free competition reign in the financial industry. And just to give you a foretaste of what I'm going to come to on that, I'm going to describe a world where continued EMU, in the sense of it holding together, depends on a lot of weak banks funding weak sovereigns, which is inconsistent with any sane model of how a free market would function in banking and finance. But let's start with the origins of the boom and bust through the last decade. And I argue, like some other monetary economists, that it was a disequilibrium in monetary conditions in the US primarily, and also in Europe, that generated the powerful asset price inflation which went through credit markets and real estate markets, culminating in the bust and financial crisis of 2008. Rate manipulation, inflation targeting, and deflation phobia created a powerful virus of asset price inflation. And I want to just step back because the term asset price inflation may be something many of you are not so aware of, although I'm sure you read about it or can't help reading about it in the financial media. What we mean by asset price inflation is it's a type of I would describe it as distorted signaling in capital markets that comes about through central banks, and particularly in the US, steering rates well away from neutral levels and trying to manipulate long-term rates. And this monetary manipulation creates many of the phenomenon which come under reaching for yield, desperation for yield, chasing speculative stories, irrational exuberance. Many of you will have read in your courses, I think, about Robert Schiller and irrational exuberance. But in many ways, one has to link that concept of irrational exuberance to the monetary background, in the sense that irrational exuberance isn't a phenomenon that's of equal importance every day of the year and every year in the decade. Irrational exuberance is promoted and generated by monetary disorder. So when interest rates are being held at artificially low levels, this induces investors desperate for yield to follow so-called speculative stories. There's always many speculative stories at most of the time, whether in 2009, 10, 11, the speculative story was China boom. If we go back to the decade of the bubble and burst in Europe and the United States, there were many speculative stories that European banks were in a great new age of European monetary integration where they could grow for many years and have huge profits. There was Spain becoming the Florida of Europe, where Germans and English were going to retire and prices of real estate rise forever. There was a speculative story of real estate home ownership in the United States. these speculative stories, but most of the time, if there was a stable monetary background, investors would treat fairly skeptically. In a situation of monetary disorder, they come to treat these as if they are almost certainly true. So you have it's as if the monetary disorder encourages investors to put on rose-colored spectacles, which have the effect of exaggerating expected returns, and believing these speculative stories, and also tends to deflect the dangers so that investors don't correctly assess the dangers. Now, the link which I come on to between this irrational exuberance as created by asset price inflation and the financial system is that if you imagine, let's imagine what a free market banking system would really look like, which wasn't dependent on a huge amount of regulation. What this free market banking system would look like would be there would be no too big to fail institutions. The discipline on the banks, to operate in a profit-centered way and risk and correct assessment of risks. The mechanism, the market mechanism which would encourage banks to act in this way would come through the discipline of the deposit markets, the bond markets, and the equity markets. A bank which was acting irresponsibly and taking on a huge amount of risks and maybe chasing one or more of these speculative stories on their own would find that deposits were leaving the bank, or they would find that their equity price was being depressed, or their bonds would be going to a big discount. But in a world where there's a lot of monetary instability and asset price inflation in particular, episodes of asset price inflation, this discipline of the market fails to operate, because what you see in almost all these financial bubbles through time, which eventually involve the banking system, is that there's also some sort of asset price inflation in the financial equity market. You know, I like to tell the story of, if one thinks back to 2007, at the time of the ABN AMRO takeover, which was really the peak of the bubble in summer 2007. What's incredible when we look at that episode in hindsight and also contemporaneously was that almost all the shareholders of banks taking over ABN AMRO approved of that merger. So what was going through the mind, this shows you that there was a sort of sickness in the equity market at the time, that they were failing to realize what the gigantic risks that they were going into and the poor nature of the returns. And to explain that, you really have to understand that there was some sort of bubble in financial equities throughout that decade, both in the US and Europe, which was being stimulated by the monetary disorder. That the monetary disorder created a lot of yield chasing, a lot of irrational story chasing, and the story of the banks was the brand new age of European monetary integration, or the brand new age of financial innovation in the United States with all the new techniques for measuring risk, etc., etc. And another aspect of this asset price inflation, as driven always by monetary disequilibrium, produces a lot of carry trade type transactions. What I mean by carry trade is there's three forms of carry trade. One is where investors move from low interest rate monies into high interest rate monies to get extra interest, and sort of assume that they're not going to be caught out by the exchange rate. Investors also tend to move from the low risk credits to the high risk credits to get extra yield and hope they're not going to be caught out by bankruptcy. And they also move from short maturity debt to long maturity debt, hoping that they'll get the higher yield on the long term debt without being caught out by the change in the term risk premium. Now, in a situation of monetary disorder where there's a great hunger for yield and a lot of irrational exuberance around, these carry trades boom. And of course, it's not just outside investors who are doing these carry trades. It's the banks themselves, the financial institutions get caught into. It's very attractive for financial institutions to chase these carry trades. Now, again, if you had a stable monetary order with the deposits and the banks, the depositors and the bondholders and the equity holders disciplining through market mechanisms, the banks that were chasing irresponsibly these carry trade activities would find themselves in problems. But that's not the situation where you have this background of the monetary disorder. Now, another point I would mention here before I come on to the topic of Europe in particular is in looking at the irrational exuberance, the government or the depositing, the existence of government regulation and potential bailouts creates some very distorted incentives, in the sense that if there's a idea that there's a government authority which is ready to, under most circumstances, to bail out banks where they make big mistakes, and there's some implicit or explicit insurance for deposits, then that creates incentives for banks to try to take a free ride on the insurance. You know, if you insure a car, you insure a house. I'm sure you've done your business studies. There's certain perverse incentives that the person who's insured, if he's not constrained sufficiently by the conditions in the insurance policy, has a lot to gain through doing wild things, and the insurer didn't realize what in fact he was insuring. And it's something like that in the banking system. But if there's an insurance of deposits and potential bailouts, and the banks somehow are not really being charged enough for this insurance, and they are not being restricted in what they do so as not to land the insurer in big losses, then they can take a free ride and hope to make a lot of gains through acting in a fairly irresponsible fashion. Now, in the last bubble and bust of the 2000s, clearly one can say with hindsight that banks did operate in that way, that they had perverse incentives through the assumption that there were going to be, if anything went wrong, there were going to be bail-ins or not bail-ins, but bailouts and insurance. What we've seen since the crisis has been an attempt of the insurers, if we use the metaphor of insurers, having learned from the large losses they experienced during the crisis, to greatly now increase the policing of the institutions, their insurers, and insisting that the insurer, that is the banks, hold much more capital, equity capital, have much more equity backing. So if the insurers and the taxpayers don't find that they are losing out through the eventual crisis when it happens. Now the problem with that, so what we're moving into is a regime, especially in Europe and also in the United States, where the insurers are making very strong conditions and regulations and what bank business can be, and insisting on growing levels of equity backing. Now, there's nothing wrong with encouraging banks to hold more equity capital. I mean, in fact, in a free market system with no regulation, it would be through raising equity cushions that banks would lower their cost of funds. But what is perverse in the present system is where banks that raise a lot more equity capital and are successful in raising a lot of equity capital don't get any reward in terms of being freed from these regulatory conditions, because after all, if a bank is successful through its business model and getting a lot of equity capital, then why do they have to be regulated as fiercely in terms of what risks they can undertake or not undertake as other institutions that are much more dependent on that on those financings? So ideally, you would have a system where banks could exit from a regulatory regime if indeed they could demonstrate that they had very comfortable levels of equity financing due to their particular business model. But that's not in the present system at all. Now, I want to return to the subject of Europe, as again, I think this is something that would interest you, this audience in particular. In Europe, since the crisis, we've had this growing regulatory effort in European banking and growing effort to impose higher capital requirements on the banks. Now again, there's nothing wrong with moving in that direction of higher capital requirements, but there has to be an environment in which the successful banks with good business models can actually raise equity capital. And the problem in the European banking situation is that, as I indicated at the beginning, that banks in many parts of Europe, Italy, Spain, have essentially entered into an understanding with the EU and with their own governments and the ECB, whereby they're assuming a special role in funding weak sovereigns. So if you're a Spanish bank, it's implicit that you fund the Spanish government. If you're the Italian banks, it's implicit that you fund the Italian government. And that's fine as far as your bottom line is concerned at the moment. It's a good carry trade. It's one of the carry trades to borrow the ECB for pretty well zero, or borrow from the press savers in Italy and Spain. You can't go anywhere else. And you go into the Italian or Spanish bond market and you record your 3% carry as profit. You're exempted from all capital requirements under the BIS or anyone else. You hold this capital free. No regulator will give you the raps for holding Spanish or Italian bonds in those countries. And you can count on the OMT program or some other like program to bail you out if anything goes wrong in the greater interest of EMU survival.
I'm sorry, what is the program?
OMT, the Outright Monetary Transactions Program of the ECB.
Could you explain that?
That's the program that was floated in 2012 during the Italian-Spanish bond market crisis, where the ECB, with Draghi, drew up this program for buying monetary financing of short-term government debt under certain situations if there was crisis. Of course, that's now all a bit under a cloud because of the Constitutional Court ruling in Germany, but that's the program I'm referring to.
Exactly.
So these, and part of the deal also, as far as the Spanish and Italian banks, of course, is that there's no free entry. I mean, you could imagine maybe a new sort of bank would open up in Spain or Italy which didn't take part in this government financing, had much better, stronger balance sheet, and could attract deposits on much keener terms than their weaker competitors. But of course, banking industry is very strongly controlled. There's not free entry. There wouldn't be bank licenses given in Spain were it to such a competitor. So this is all very much in line with, some of you may have seen a book by Colomaris and Harbour describing describes the grand bargain there's always been through decades and centuries between the state, the banks, and the merchant class. But essentially, the banks are part of the have an intrinsic bargain with the state to provide the financing to in this case, a weak sovereign. And that's the heart of the crony capitalist system. But so when you're looking at reforming European banks and allowing banks to compete and free them from regulatory requirements, that sort of agenda in Europe runs directly contrary to the Brussels agenda or the Frankfurt agenda of doing everything possible to shore up EMU. And as there's limits to how much this can be done through monetary financing, the next best thing is getting the banks to cough up and buy the government debt. But by doing that, they implicitly weaken the banking system and make it impossible for the banks to compete on a free market system. And I just want to finish up here. I know I've got quite a bit more we can discuss in the question and answer session. But I just want to finish up with maybe looking at a political perspective as to how could we imagine the tide of regulation turning back? How could we imagine, given the great majority consensus in the political system today in favour of regulation, how could we imagine this turning back? And I think the best lead into that is some of the ideas put out by Luigi Zingales at the University of Chicago under his proposals for making capitalism more popular. But essentially what you would have to have is let's take the American context. I mean, suppose the Republican Party in the US, instead of, as they did do when Romney was their candidate, sort of to some extent cozying up with Wall Street. Suppose the Republican Party in the US were to make its agenda competition, capitalism and competition, from which Mr. Everyman would benefit rather than the elites. And they would attack the sort of crony capitalism in Wall Street for too big to fail institutions. They would promote the benefits of monetary stability, showing that the beneficiaries of monetary stability would be Mr. Everyman rather than than Wall Street. And part of this agenda would be competition in the financial sector and breaking up the too big to fail institutions. And on that note, I want to really go to the next talk and come back to more questions later.
I'm Anne, I'm the moderator coming from London, and I'm extremely sorry for being late, especially because where I'm coming from, they're extremely interested in the kinds of ideas that might come out of such a conference. So I'm sorry, I can't see the names to next week. Please go ahead, I'm so sorry for being late.
I'm sorry. When can we ask you the questions?
We could do that now.
We leave it to the moderator.
Has everyone made their sort of opening statement, their opening argument of ideas?
I'll be very brief, so we can probably get to the questions.
Okay. Yeah, thank you.
I mean, I'd like to make you believe that Brendan's stolen all my best ideas, but I mean, I've only got a couple of slides I've put together here for you, and what I wanted to present maybe was a little bit different perspective. I work for AllianceBernstein, so we're a large global investor, and I particularly analyse banks. I wanted to sort of address the title of the conference in terms of can a free market solution be applied to banks? And I think the key starting point when we think about banks and a potential to apply free market solutions to them is the systemic importance of banks. And Brendan mentioned the concept of too big to fail. And I think it's kind of part of, or that goes hand in hand with the concept of interconnectedness. So globally, when we look at the large banks across all the countries, they're very much interconnected. And so it's that systemic risk, not only domestically but internationally, that maybe goes against the potential of free market solutions. I think where we are going to move towards, and there's a lot, this is currently going through the European Parliament, the whole concept of resolution mechanisms, and particularly bail-in, or bailing in of investors, equity and bond holders. And I think we will go some way towards bail-in, but I think as the banking system stands, we are going to continue to need bail-out. And when I say bail-out, I'm talking about deposit insurance. And I think we are going to go towards a system of banks, and I think we're going some way towards that in the UK already, of ring fencing. So you ring fence certain parts of banks, particularly the more systemically important retail commercial parts of those banks, which generally will go back to the traditional model of being funded by deposits. And that sort of ring fence bank, I think you probably will need to bail out to maintain systemic harmony, let's say. But I think in terms of that deposit insurance, that will be pre-funded, or it should be pre-funded, and the insurance will be provided by the banks. Now, the European Parliament is currently debating how that deposit insurance should be set up, or how a fund should be set up, whether it's based on a risk measure of banks, so the more risky banks should pay more, or it should be based on just the size of deposit basis. But I think that's basically where we are going to get to, is that we will have a concept of bailout pervading in the system. I think more interestingly, from an investor's point of view, in terms of what we invest in and where we're going to go towards, is this whole concept of bail-in. Bailing in equity holders, so shareholders, but from my point of view, from a fixed income point of view, bailing in bond holders, and particularly on the subordinated bonds that we're buying, but also senior bonds. So the concept of bailing in senior bond holders. Now that is very much kind of anathema in general in banking, but we have seen instances of it. So if you go back to the crisis period, it happened in the Icelandic banks. It's happened in a few other banks since, but generally it hasn't happened. But I think that's where we're moving towards. But one of the key things from an investor's point of view, yes, we can understand the concept of bail-in, and we're very much sort of open to that. But the key thing you need with bail-in is you need better data transparency. So a lot of what we're thinking about free market solutions is dependent on the concept that the market is efficient. And I would argue that the market probably isn't efficient in terms of having enough data transparency. We make a lot of money from an inefficient market. So mispriced assets, mispriced risk. People, forced sellers, particularly when you talk about people having to sell when particular bonds become high yield or they lose a certain rating. That's a sort of inefficiency in the market, and we can benefit from that. But I think if you want to go the whole way to a free market solution for a bank rescue, is you need much better data transparency in the market. And when I say better data transparency, it's got to be transparency in terms of consistency and comparability. And that's what we don't have. So as an analyst of banks, we struggle in not having comparable data across banks and across countries. And that means that the risk is mispriced in the market. Now on the second slide I put out here, I sort of titled it, Bank Regulation, Not Such a Bad Thing if Applied Consistently. So that's a very big if. So I think in theory, bank regulation isn't such a bad thing. And again, we could argue whether it should be rules-based or based on general principles. I think the big problem with regulation is it's not applied consistently. And so you do have the ability for banks to take advantage of regulatory arbitrage, i.e. moving to markets that they can gain, or markets which are generally seen as being less regulated. So I think that's kind of one of the key concepts which stands in the way, or is a big drawback to regulation. I think as Brendan says, we've always had regulation, or at least we've had it for the past 20 to 30 years. And in a way, you could argue that it hasn't been that bad, and it's just that banks have big gain in that system. I think also the way that regulation has gone post-crisis is that regulators almost are trying to extract a pound of flesh from the banks. So obviously the banking system was heavily supported by taxpayers. It's kind of the end game here. And I think since the crisis, regulation has almost gone too far the other way. And I think the Dodd-Frank regulation in the US is a case in point in terms of almost just too much regulation, too much complexity, which not only is a cost to the banks, but is also a cost to the regulators and, in a way, the government, just unable to be able to police the regulation. So I think we've got to find some common ground somewhere in between. But I think, as I said before, I think there will still be, maybe unfortunately, a role for governments in terms of bailing out banks. And hopefully it will be the smaller, less systemically important banks, but the deposit-funded banks. But I think another key point that happens if governments do bail out these banks, there's got to be a better system thereafter to sort out those banks. So if we look back at some of the banks that were rescued during the crisis, the Royal Bank of Scotland is a case in point, that these banks were rescued, but they're almost still under government control. And I think the governments, if they do step into these banks, have got to put in place a much quicker way or a quicker exit from that support, be it the creation of bad banks or much better resolution plans. So I think that's something that's going to be worked out over the next few years. So just to conclude, I mean, from an investor's point of view, I think there are key building blocks as we move more towards a free market solution, but I don't think we're ever going to get there. And I think data remains the big bugbear for me, is that we just don't have sort of the comprehensive, consistent, comparable and timely data provision to make that possible. So maybe at that point I'll turn.
Has Emiliano spoken yet?
Sorry.
Oh, is it? Okay, all right. Thank you both so much. And I know there's probably a lot of questions in the room. I was hoping to maybe get us kicked off with two. And when you all give your questions, I guess, unless you say otherwise, we'll assume that they're for both of our speakers to debate and argue as they will. But I had two. I thought that a lot of your proposals were really very interesting. When you talked about the possibility of certain institutions being able to opt out, then you mentioned the danger that they could then fall prey to unfair competition from fear-mongering. I guess I'd put that to both of you. Do you see any possible ways around that, either from a regulatory business perspective? So that would be one. And I also, I think what you're saying is very interesting, that we're moving towards a more free market system for handling regulation and letting the market engage in this kind of discipline. But you don't necessarily think we're ever going to get there. What were your thoughts on one of your proposals was to have certain banks be able to have less onerous regulatory and sort of the fee requirements as their equity buffering went up. Do you think that's a possible solution?
I think just to that point, maybe that you finished on that. I think that's almost happening already in terms of shadow banking. So when you talk about banks and we talk about banks being regulated, and part of this sort of almost over-regulation of banks is that we're moving this concept of disintermediation. So a lot of the traditional business of banks are not willing to do anymore because it's just so heavily capital constrained to do that. So a lot of that business is moving to what we call the shadow banks, or non-banks, non-regulated entities. And you could include asset managers that I work for in that group. But I think that's part of the regulation, is moving to shadow banks. The problem with that is that they're non-regulated, and potentially they are so interconnected with the banks anyway that a problem there might not necessarily be resolved by the free market, and it might spill over back into the regulated bank sector.
And unless I'm wrong, it would also potentially worsen the big problem that you see, which is data transparency and consistency.
Exactly.
Yeah, I mean, my concern would be, I think, for something inherently unstable, unfortunately, with having a regulated sector alongside an unregulated sector. It's better to have a totally unregulated, nothing regulated at all. Because I think when you have an unregulated sector alongside a regulated sector, to some extent there's going to be suspicion and actuality of the unregulated sector actually depending on the regulated sector and being various incestuous relationships. And there are going to be these unfair competition too. But I want to comment to another point which we're sort of touching on here. And I know as finance students, you probably all study Moderator and why changing the leverage ratio of a company shouldn't actually affect the overall value of that business. So if a particular business raises more equity and reduces its debt, the total value of the business should still be the same. So
I don't teach that because I don't agree to that.
Okay.
Okay, so I tell my students, forget Manley and Miller, MMN, forget it. Don't, well, I will explain to you next time why I don't teach
Well,
that.
coming from Chicago, that's what I was taught.
Well, I know, but I come from Harvard. This is the difference.
Okay, but
This is an interesting.
well, what I want to say is that what goes so wrong with banks? You know, after all the time we hear bankers saying we're being killed by having to have higher equity ratios, but if Moderator Miller held, then the bank which had a higher equity ratio, it shouldn't affect the overall value of our business. Yet the way the bankers speak, it does obviously overall affect the value of our business. And I think the solution to that enigma is that what bankers are actually complaining about when they talk about equity, having to raise equity capital, is they're complaining about their insurance policy no longer being as cheap. So under the good old days of the bubble of the last decade, they were being very undercharged for the implicit insurance they were getting, and they were being very underpleased in the risks they were putting their insurer into. Now the sort of pendulum has swung the other way, where the insurer is so mad about taxpayers and everything else, at having been the donkey there, that they're now going the other extreme of overcharging and over-regulating more than what any sort of private insurer would be charging. And then you're looking at the question, well, why do the bankers have to put up with this? Why don't they just move out into the shadow banking system? But of course, when we're looking at the issue with the regulated and the unregulated institutions, there are sort of many perverse incentives. And I think the solution I'm sort of talking about in my material is twofold. One, there should be an override, but if institutions do go out and raise a lot of equity capital, so that basically there's not much insurance to be done because we're so well provided with equity, then they should be allowed a much lighter regime, because they're not really asking for any insurance anymore. So that would remove one of these perverse incentives. But the much more fundamental one is that if you take away all insurance altogether and you break up the too big to fail institutions, you do away with the insurer. The insurer, the depositor, becomes the equity holder, and the bond holders and the banks, who through market mechanisms in a stable monetary order will police the institution as to what risk they're running up, and if they're not happy with it, the bonds will slump, the equity will slump, and the bank management will have to change.
I think that's fine to a point, but the one thing which is in the banks are retail depositors. And you've got to assume that retail depositors are not sophisticated. They can't assess the risks the banks are taking, so there needs to be some level of insurance there. Or you just say to banks, the future banking business model is you don't take deposits. Deposits or saving products go to insurance companies or to asset managers. But because you do have that unsophisticated investor who can't assess risk, there's got to be some level of insurance to protect them. I wholeheartedly agree that investors like us who are buying the bonds and shareholders, they should be on the end of the losses, so they should be sophisticated enough to assess the risk and price the risk and take the losses on the other side of it. But I think you do need to have some level of insurance for the retail depositors in these banks, or you say that they need to, there is no insurance, but they need to go somewhere else.
Which of course is what happened. If you go back to before 1930s, when you got deposit insurance introduced in the United States, if you're a small depositor and you don't want to take the risks in a bank, and you feel you're unsophisticated, you either go and buy government bonds, or you buy savings bonds, or you go into postal savings system.
You put it on your mattress.
Yeah.
I mean, there's also, when you talk about a retail investor going and putting his money in government bonds, obviously in most economies in the West, that's not such a big risk, but there's clearly not a risk-free proposition in terms of government bonds for all retail investors. I mean, I'm sort of wondering about how this wrinkle of whether or not this would actually be possible to strip away all insurance versus if you did, you know, ring fence and said, okay, retail depositors will put their money in insurance or what have you. Does that create sort of maybe an unacceptable two-tier system where there are fewer opportunities for, I mean, because retail investors, yeah, they're probably not as sophisticated, but at the same time, a lot of them are sophisticated enough to know that there could be risks that they could be taking, but they're cut off from them.
I mean, again, it would come to data transparency. You know, would mom and pop actually be able to take, risk assess such an opportunity? I mean, I think you either do the route of the ring fencing, where you say, okay, we're going to ring fence this bank. You know, retail deposits will go into it, but the risks that bank are going to take are going to be relatively low. They're going to be a traditional maturity transforming deposits into mortgages, for example, or you say that those deposits have to go to insurance companies who are going to have long-term savings products, akin to pensions, and that's the way you save.
Excuse me, I have a question.
Yes.
Because you said that there were a lack of transparency and that make the market inefficient. And now you speak about the retail investor that is not sophisticated enough to take good decision. But I should say that there is not a transparency for the retail, for the depositor in the bank. So if you are looking to the information that is bring to us, everything is fine. So transparency is zero. So it's impossible to have to take the good decision. So what can we do in order to save our money? Because now we are aware that the banking system is failing.
Yeah. When I talk about transparency, I talk it more from the professional investor's point of view, so the people who are assessing the risk and putting money to work are actually buying either the shares or the bonds, and understanding that that's where the losses are going to be. Because when you look at the way banks' funding or banks' sort of liability structure is set up, for a traditional bank, the large part of it remains retail deposits, or corporate and retail deposits, but a combination of deposits for a lot of these banks remains the key liability. And then underneath that you'll have senior bonds, or covered bonds in some instances, which are guaranteed. And then the sliver at the bottom that we're talking about, which is the equity capital that shareholders put in, and the more subordinated debt that we as bondholders might be buying, that is very risky, and that is the sliver which is going to take losses in the first instance. And if you go back to the crisis period and some of the losses that banks were taking then, and even the biggest losses, for example, RBS took 45 billion, UBS took tens of billions as well. That nominal amount of losses that those banks were taking, even if you assume that since then banks haven't de-risked, which they actually have, but if banks hadn't de-risked and we assume that those were the largest losses that some of these banks could take now, they would be absorbed by equity capital and subordinated debt, and for some banks a sliver of senior bonds. But they would never, it's very unlikely that they would ever get into the deposits where a depositor would lose money. The problem is banks don't really fail or go bust because of having a lack of capital. They tend to fail because of liquidity. So if you go back to Northern Rock, for example, it wasn't necessarily they didn't have enough capital, it's that there was a run on deposits, but there was a run on the wholesale sort of market as well. So that's where banks tend to fail. So transparency, when I'm talking about transparency, more transparency for professional investors to be able to assess that risk.
I would like to add one or 2 points there. First of all, transparency. By competition, you should get transparency. If you have an unregulated market, no too big to fail institutions, no insurance, except you can debate whether you have insurance for the first $5,000 or whatever. But that's not a fundamental distinction. You consider two institutions, financial institutions, one who has fantastic transparency standards, discloses their loan book, all their carry trades, the risk, and another institution which operates cloak and dagger and nobody knows what they're up to, which one's going to have a higher share price? So I would say the free market would actually encourage transparency in an unregulated system without that being policed by regulator. And the problem, once you get the regulation, in fact, you get the opposite of transparency. As I come back to my point about Spain and Italy, you know what's happening there with the Spanish and Italian banks being induced by a whole lot of political backroom negotiations to go fantastically into supporting their own domestic bond markets. What free market institution would be doing that? They would be slaughtered by the bondholders and the deposit holders, and they'd be closing their doors. So what you've actually got in Europe towards keeping the European Monetary Union alive in Spain and Italy, they've completely repressed the free market mechanisms. And that's been a deliberate choice.
And that also goes somewhat to the point you were making about the need to develop exit plans. I mean, as far as I can tell, in Spain and Italy, the idea of an exit plan, certainly a transparent, predictable one, let alone one that would be replicated as some kind of model for banking resolution, is nowhere necessarily on the horizon.
I mean, look at this big EU stress test that's coming along. I mean, it's not going to be highlighting this bond risk, is it, in Italy and Spain, as far as I know?
As far as we know. I mean, there's always hoping. There is always hoping. I don't know. I think a lot of times in these conversations, one teeters between extreme pessimism and extreme optimism. And, of course, we're all trying to find a potentially reasonable, politically possible solution forward. I wanted to ask very quickly, because you mentioned Dodd-Frank and the risk of extreme over-regulation, which, again, I know you said it's a lot of these guys just saying, oh my gosh, the price of my insurance went up. But, I mean, being American, I'm, of course, very concerned and terrified of Dodd-Frank. I just pictured 10,000 pages of rules literally falling on small retail, mom-and-pop consumers, small business owners. I mean, aside from the large banks that actually keep the gears running. In your notes, you mentioned that the horizon actually looked somewhat brighter in the U.S. than in Europe. I was hoping you could maybe unpack that a little and tell us why. Is there more agreement here than was immediately obvious?
I think that's more hope than necessarily something I can point to. But as I was outlining here, there is a political evolution possible in the U.S. I was suggesting that if the Republicans were really to try to make a national message of restoring free competition and making capitalism popular, it's a bit like I mentioned Professor Zingales at the University of Chicago. He actually highlights the fact that if you go back to the Boston Tea Party, it wasn't actually a protest at that time against colonial rule. What it was a protest against the monopoly of the East India Tea Company. Mm-hmm. So intrinsic in the American political ideal is anti-monopoly. Yeah. So could the Republican Party capture that in attacking the monetary instability, the money printers, the Wall Street barons, and go back to a sort of popular model of capitalism? So that's more a hope rather than something. A hope of a rather than something I'm pointing at. But it does touch another issue, which is in the American system and Europe. Why have the central bankers, who were responsible for the asset price inflation and the monetary disequilibrium which lay behind all this, sort of escaped all criticism in the political arena? Largely, except for with Ron Paul, etc. But largely they've escaped the criticism. And the politicians have sided with the view that the way to prevent future crises is to regulate, rather than to reform the central banks and have monetary stability. Why have that? You know, look at what has happened in the US since 2008. You know, you could say that Bernanke and Yellen voted yes to every single decision which led to monetary instability through the first decade of the 21st century. Yet Bernanke gets reappointed by Obama, and then Yellen gets appointed as her successor, although both of those signed on to every monetary mistake that was made. And yet in both cases, the the dominating appeal to the White House and some of the Democratic Party seems to be that they were big regulators. I mean, essentially, Bernanke did a deal with Dodd-Frank or Frank or Dodd, I don't know which one, that in return for getting his nomination, he would support the Frank Dodd Act. So that was like a deal with whether he believed in regulation or not. That was for terms of his getting renominated. If you look at Yellen, why did Yellen win out against Summers? Basically because the Democrat Party wanted regulation. They didn't trust Summers. And Yellen, despite all the monetary failures with regards to signing on to every monetary mistake, they could be reasonably sure she was going to support regulation. So why does the political process favour a regulation rather than a monetary reform? Maybe that's a question to you.
Well, I thought in your notes you actually touched on one, to me, seems quite obvious answer, or at least in part, is that politicians, certainly in the US and in Western Europe, on both sides of the aisle, I argue, rely to a large extent on the inflation that the central bankers make possible. It's part of their policy. Yeah. I mean, is that enough of an answer, or I don't know? Do you maybe take issue with the premise that they should be taking on more blame or reforming their own ways?
Yeah, I mean, I think the regulators were partly to blame for what happened. I think there was very much a light touch in a lot of these instances. I mean, I think the US has probably gone too far, but I think the US banks are in a stronger position than the Europeans anyway. So they handled the crisis in a much better way than the Europeans have, in terms of putting capital in, but forcing the banks to repay it very swiftly. Whereas the Europeans have been on in intensive care for a number of years. I think that another problem in Europe is that yes, we've got Basel III, but it's the way that's implemented into CRD4, and then the ability for national regulators to adopt, differences or different ways of implementing that in their own countries, which again is a bit of an issue. And then you'll have almost sort of the gold standard, or the gold plating that the UK and the Nordic regulators are doing. And then you could say, okay, are there banks, stronger banks than the French or the Germans? And potentially they will be because of that regulation. But I mean, I generally I think you still need regulation as long as you have retail deposits involved in the system. And I can't get away from that concept. But I think if you were to go to a free market and say those deposits go somewhere else and we will insure mom and pop somewhere else, I think fine, get rid of regulation. Let the shareholders and the bondholders regulate the market and price risk accordingly.
And what about the central bankers? Are they overdue a meeting with our pitchforks, or in perfectly crude terms?
Sorry, no.
Sorry, that was
I think perhaps the floor has a lot of questions.
Oh, I'm sorry. Let's open. Raise your hand, sir.
Oh, yeah.
Go ahead. Did you have one?
No.
Okay, sorry, go ahead.
I have one question. Mr. Brown, you said that in order to stop the asset price inflation, we should start to refund you say you propose that the Republicans come with something. But I have the impression that we came to this point because there are quite a few corruption between Wall Street and the US government. So I'm not sure that this will happen soon. So I suppose that in case it does not happen, it will continue to have asset price inflation. And I would like to know what do you think is it right now?